Imagine you walk into a hospital. You're bleeding. Someone else walks in behind you. They're also bleeding, but they get seen first. Not because they're bleeding worse. Not because they arrived first, but because of who they are, where they work, who their family is. Now imagine that hospital is the entire financial system. And imagine the bleeding never really stops. It just moves around, from person to person, from crisis to crisis, pooling quietly at the bottom while the people at the top get stitched up, patched, propped back up, and sent home before you've even filled out the intake form. That's not a metaphor for something that might happen. That's a description of something that already does. And it has a name. It has a structure. It has tiers. It has rules. Written and unwritten. Official and deeply unofficial. Banks have classes. The financial system has a hierarchy. And depending on where you sit in it, or more likely, where you were placed in it without ever being asked, the rules are completely different. Different interest rates. Different access. Different bailouts. Different consequences. Today we're going to walk through the whole thing. From the very top of the pyramid to the very bottom. We're going to name names, explain the mechanisms, and at the end we're going to sit with a question that doesn't have a clean answer. Because the most important things usually don't. Let's start at the top. And I mean the actual top. Not JP Morgan. Not Goldman Sachs. Not even the Federal Reserve, though we'll get there. The very top of the global financial hierarchy is a building in Basel, Switzerland. Basel. Neutral. Quiet. Famously associated with art fairs and pharmaceutical companies. Not exactly where you'd expect to find the architecture of global financial power. But there it is. The Bank for International Settlements. The BIS. Founded in 1930, technically to help Germany manage its World War I reparations. That's a remarkable origin story. A bank designed to process the financial fallout of the deadliest war in human history up to that point. And what did it become? The central bank for central banks. Let that sit for a second. There is a bank whose clients are other banks. Not individuals. Not corporations. Not governments exactly. Other banks. Specifically central banks. The Federal Reserve. The European Central Bank. The Bank of England. The Bank of Japan. Roughly 60 institutions, representing the monetary sovereignty of most of the developed world. All of them with accounts at this one building in Switzerland. Most people have never heard of it. It doesn't advertise. It has no branches. You cannot open an account there. You cannot visit as a tourist. It operates under a legal framework that gives its staff diplomatic immunity. The institution itself is exempt from Swiss law in many respects. It is, functionally, the most powerful financial institution most people on Earth will never know exists. This is Tier 0. This is where the rules are written. Now let's come down one level. Central banks. You've heard of these. The Federal Reserve in the United States. The ECB in Europe. The Bank of England. The People's Bank of China. These institutions are fascinating because they are simultaneously incredibly powerful and technically accountable to the public. They are either government-owned, quasi-governmental, or privately structured but publicly mandated depending on which country you're looking at. The Federal Reserve, for example, is technically owned by its member banks. Private institutions. But its chair is appointed by the President of the United States. Confirmed by the Senate. It's a hybrid. A strange, historically specific, deliberately ambiguous hybrid. What central banks do at their most fundamental is control the price of money. That's it. That's the job. When the Federal Reserve sets the federal funds rate at 5.3%, it is determining what it costs banks to borrow money overnight. And from that one number, almost every other financial price in the country is derived. Mortgage rates, car loans, credit card interest, the yield on your savings account if you're lucky enough to have one, the valuation of every stock in the market because stocks are priced relative to the risk-free rate you can get from just holding government bonds. One number. set by a committee, meeting 8 times a year, in a building in Washington, D.C. That's a lot of leverage for a relatively small group of people. And here's where the first uncomfortable truth arrives. Central banks were designed, in theory, to be independent of politics, to make cold, rational decisions about the price of money based on data, not elections. The idea is that if politicians controlled interest rates, they'd keep them artificially low before elections to juice the economy, and the whole thing would spiral into inflation or worse. Noble idea. But here's what actually happened. In 2008, when the financial system collapsed, and we'll talk more about why and how, the Federal Reserve did something it had never done before at anything like that scale. Created money. Not metaphorically. It expanded its balance sheet from roughly $900 billion to over $4 trillion over the following years. By 2022, it had hit nearly $9 trillion. $9 trillion. To put that in context, the entire U.S. federal budget in 2008 was about $3 trillion a year. The Fed created 3 years of government spending worth of new money. And it used most of that money to buy assets. Mortgage-backed securities, treasury bonds, from banks, at prices that, in some cases, the market would not have paid. This is called quantitative easing. QE. You've heard the acronym. The mechanism is worth understanding. When the Fed buys a mortgage-backed security from a bank, the bank gets cash. Cash it can then use to make loans, buy other assets, or just park back at the Fed in reserve accounts earning interest. What it does not necessarily do is lend that money to small businesses or ordinary people at affordable rates. The money entered the system at the top. Where it went next was not guaranteed. Where it actually went largely was into asset prices. Stocks, real estate, things that people who already had assets owned. And so the decade following the 2008 crisis became one of the most dramatic wealth transfers in modern history. Not through taxation, not through policy, through the structure of how money enters the system and who's closest to the door when it arrives. Economists call that proximity to newly created money the Cantillon effect, named after an 18th century French-Irish economist named Richard Cantillon, who noticed that who gets the new money first matters as much as how much new money there is. He figured this out in the 1700s. We're still living inside his observation. Let's come down another level. Tier 2. The big commercial banks. J.P. Morgan Chase, Bank of America, Wells Fargo, Citigroup. In the U.S., these are what the Financial Stability Board officially designates as global systemically important banks. GSIBS. The list also includes institutions like HSBC, Deutsche Bank, BNP Paribas, Barclays, and a handful of others depending on the year. The designation is not honorary. It comes with specific capital requirements, stress tests, regulatory obligations. And it comes with something else. Something unwritten but universally understood. These banks are too big to fail. That phrase has been so thoroughly discussed since 2008 that it's almost lost its strangeness. Let's restore the strangeness for a moment. Too big to fail means that these institutions are so deeply embedded in the plumbing of the financial system, so interconnected with other banks, corporations, pension funds, money market funds, foreign governments, that if they collapsed, the damage would be so catastrophic and so unpredictable that governments would rather spend public money propping them up than find out what happens if they don't. It is functionally a guarantee, not a legal one, not a written contract, but a credible implicit promise backed by observable historical behavior. And markets price that in. Studies have estimated that the too-big-to-fail subsidy, the lower borrowing costs these banks enjoy because creditors know the government will step in, is worth somewhere between $15 and $80 billion per year for the largest U.S. banks alone, depending on methodology and market conditions. The IMF put out a working paper in 2014 suggesting the global subsidy for the largest banks was over $300 billion annually. $300 billion per year. Not as explicit payments, as a structural advantage embedded in how the market prices their debt. They borrow more cheaply because the world assumes they'll never be allowed to die. And what do they do with that advantage? They grow. They acquire. They become more systemically important, which makes the implicit guarantee stronger, which makes the advantage larger, which makes them grow more. It's a loop, a rather elegant one if you're inside it, a rather maddening one if you're observing from outside. Now we come to the level most people think of when they think of banks. Regional banks. Mid-size commercial institutions. The ones with a presence in your city but not necessarily in every city. Institutions like SVB Silicon Valley Bank before March of 2023. This is where the class system gets sharply visible. Because in March 2023, Silicon Valley Bank collapsed. It was the second largest bank failure in U.S. history. It happened over roughly 48 hours. And the immediate question that the government faced was the same one it always faces. Do we let it fail or do we intervene? And here's where it got interesting. SVB's depositors were not ordinary people. They were mostly tech startups and venture capital funds. Businesses with millions of dollars sitting in accounts. The FDIC insurance limit is $250,000 per depositor. The vast majority of SVB's deposits were above that limit. Technically uninsured. By law, those depositors should have been at risk. Within 72 hours, the federal government announced that all deposits, insured and uninsured, would be made whole. EBT. The official reasoning was systemic risk. The argument was that letting those deposits evaporate would cause panic and contagion throughout the regional banking system. Maybe, probably even. But notice what happened. A bank whose clients were predominantly wealthy tech companies and venture funds received a bailout that went beyond what the law technically required. While, simultaneously, a community bank serving lower-income neighborhoods that fails often receives no such special treatment. Its depositors get what the FDIC owes them and nothing more. Same country, same banking system, different outcomes. The size and nature of your depositor base, the class of people you serve, shapes how the system responds when things go wrong. This is not conspiracy. It is not malicious design necessarily. It is structural. It is the natural output of a system where political and economic pressure flows from organized, wealthy constituencies toward decision-makers who respond to that pressure. That's how systems work. But knowing that doesn't make it less consequential. We're halfway down the pyramid now. Let's keep going. Below the regional banks sit the smaller community banks and credit unions. About 4,500 FDIC-insured community banks in the United States as of the mid-2020s. These institutions are, in many respects, the most important banks for the actual economy. They make a disproportionate share of small business loans. They serve rural communities that larger banks abandoned decades ago when branch profitability calculations made those locations unviable. And they are disappearing. In 1984, there were over 14,000 FDIC-insured commercial banks in the United States. By the early 2020s, that number had fallen to roughly 4,500. That's a loss of nearly 10,000 banks over roughly 4 decades. Not because of financial crisis, because of consolidation, because large banks bought small ones, because thin margins in markets the big banks don't value enough to serve but are just profitable enough to gut if they wanted to. The financial system, left to its own devices, consolidates, centralizes, concentrates, and as it concentrates, the communities at the periphery, rural, low-income, less politically connected, lose access to the thing the whole system runs on: credit. Not because they're undeserving, not because they're poor financial risks necessarily, but because the math of serving them doesn't work for an institution optimizing shareholder returns at scale. This is where the class system stops being abstract. Below community banks, we find something that most mainstream financial commentary treats with either condescension or alarm. Alternative financial services, check cashers, payday lenders, rent-to-own stores, pawn shops. These are, by almost any objective measure, extraordinarily expensive ways to access financial services. A payday loan with a 2-week term and a $15 fee per $100 borrowed has an annualized interest rate of roughly 390%. 390%. The average credit card charges somewhere between 20 and 30%. The average mortgage charges somewhere between 6 and 8% in recent years. 390%. And yet, roughly 12 million Americans use payday loans every year. Not because they're financially illiterate, not because they enjoy paying 390%, but because they have no alternative, because they're unbanked or underbanked, meaning they either have no traditional bank account or they have one that doesn't functionally serve their needs, and because the emergency is real and the date is today and the bank isn't interested. The Federal Reserve has found consistently in its surveys that a significant portion of American adults, around 30% in some years, could not cover an unexpected $400 expense using their savings or a credit card. They'd have to borrow or sell something for $100. And the system's solution for those people at the bottom of the pyramid is a 390% annualized interest rate. The further down the pyramid you are, the more you pay for the same thing. Money, access to money, the ability to bridge a gap between now and next week. This is not a coincidence. This is the geometry of the system. Now let's zoom out, because the domestic hierarchy is real and important, but it's embedded inside something larger. A global hierarchy that works by similar logic at planetary scale. Countries have credit ratings. Sovereign debt ratings issued by Moody's, S&P, and Fitch, 3 private American companies whose assessments determine how cheaply or expensively governments can borrow on international markets. AAA-rated countries like Germany or Australia borrow at near risk-free rates. Lower-rated countries borrow at significantly higher rates. The difference in interest payments over decades can determine whether a country can build hospitals or can't. And here's the part that should make you pause. The rating agencies have a track record that is, to put it charitably, imperfect. In 2008, they had rated enormous tranches of mortgage-backed securities, bundles of home loans to people with poor credit sold to investors as safe as AAA. The highest possible rating. The same rating as the U.S. Treasury. The same rating as German government bonds. Those securities subsequently lost most of their value. The rating agencies were not prosecuted. Their business model was not fundamentally changed. The same 3 companies continued to rate sovereign debt, corporate bonds, and complex financial instruments, with slightly updated models. The same essential structure. And yet, a developing nation that falls behind on IMF loan repayments because of a drought or a commodity price collapse or a currency attack by speculative traders gets downgraded. And the downgrade raises its borrowing costs. And the higher borrowing costs make it harder to recover. And the difficulty recovering leads to further downgrades. That spiral has played out in Argentina, in Sri Lanka, in Zambia, in Ghana, in a dozen countries over the past 30 years. The global financial system has tiers. And the consequences of being in the bottom tiers are not abstract. They are hospitals not built, schools not funded, debt repayments that exceed healthcare budgets, entire generations whose futures are shaped by the interest rate their government pays on money it borrowed before they were born. We need to talk about the architecture underneath all of this, because the hierarchy isn't maintained by conspiracy or secret meetings. Exactly. It's maintained by something more durable and more insidious than that. It's maintained by infrastructure. Consider the following. The global payment system runs primarily through a network called SWIFT, the Society for Worldwide Interbank Financial Telecommunication. Based in Belgium. When money moves between countries, when your international wire transfer clears, when a multinational corporation pays a foreign supplier, it almost certainly passes through SWIFT. And SWIFT is not neutral. It is governed by a board where Western financial institutions have historically held dominant positions. When the US and EU decided to cut Russia off from SWIFT following the 2022 invasion of Ukraine, they could do it. They did do it, and it caused significant economic disruption. The ability to flip a switch and cut a country out of the global payment system is a form of financial power so profound that it reshapes geopolitical calculations. And it resides not in a treaty organization or a democratic body but in a messaging system operated by a Belgian cooperative. Similarly, the US dollar's status as the world's reserve currency, the currency in which most global trade is denominated, in which most central banks hold reserves, gives the United States a structural advantage that economists call the exorbitant privilege. America can run persistent trade deficits because the world needs dollars. It can borrow more cheaply than any other country because everyone needs its currency. It can impose economic sanctions that bite harder than anyone else's because dollar transactions flow through the U.S. financial system regardless of where the parties are located. This is Tier 1 power at the national level. The ability to define the rules of the game for everyone else. And the countries that don't have it, which is most of them, navigate a financial system built around assumptions and architectures that serve someone else's interests first. Let me bring this back to you, specifically, because you're watching this, which means you're somewhere in this hierarchy. And the question of where you are shapes almost everything about your financial life, whether you think about it in those terms or not. If you have a mortgage with a 30-year fixed rate and a good credit score, you are accessing credit at terms that would have been unimaginable to most people throughout human history. The ability to borrow hundreds of thousands of dollars at a fixed interest rate for 3 decades is a remarkable financial product. And it exists partly because the government guarantees it through Fannie Mae and Freddie Mac, which are themselves in a fascinating middle space between public and private that caused an enormous amount of damage in 2008. If you have credit card debt, you're paying somewhere between 20 and 30% interest on money borrowed from a bank that itself borrowed at around 5%. The bank is making 15 to 25 percentage points of margin on that transaction. Every month you carry a balance. If you have no credit history, maybe you're an immigrant, maybe you're young, maybe you've never had accounts the system recognizes, you're essentially invisible to the formal financial system, which means you're pushed toward the expensive informal tier. Through no fault of your own, because the system requires a history it wouldn't give you. The system doesn't just charge you more when you have less. The system is designed so that having less makes you more expensive to serve, which means you get worse service, which makes it harder to accumulate more, which keeps you in the tier where you're more expensive to serve. Financial gravity pulls downward. You have to apply significant and sustained force to move against it. Here's the part where most financial videos tell you to open a high-yield savings account and max out your Roth IRA. We're not going to do that. Not because those things are bad ideas. They're fine ideas. It's true that you should understand the system you're operating in, because we've spent the last 20 minutes looking at a system that distributes risk and financial literacy structural position. It's true that the decisions individual optimization is the primary answer to a structural problem. It's also true that the most financially literate person in a payday loan office is still paying 390%. It's also true that the least financially sophisticated Goldman Sachs partner is still getting access to investment opportunities that will never appear on any retail platform. The system is not neutral. It is not a meritocracy of financial wisdom. It is a hierarchy with structural advantages at the top and structural disadvantages at the bottom, and most people move through it without ever seeing the architecture that shapes their experience. So here's the question we're going to end with, and I want you to sit with it, because I don't have a clean answer and I'm suspicious of anyone who does. The financial hierarchy, the tiers, the access gaps, the implicit guarantees, the Cantillon proximity to new money, the global reserve currency privilege, the 390% payday loan. Most of this is not hidden. It's documented, studied, It's published in IMF working papers and Federal Reserve research and peer-reviewed journals. It's not secret, and yet the hierarchy persists. The consolidation continues. The gaps widen. Is that because the people at the top are maintaining it deliberately? Sometimes. Lobbying is real. Regulatory capture is real. The revolving door between banks and regulators is real and well documented. But is it also because the system, once built, simply runs? Because the incentive structures push every participant, banks, regulators, politicians, investors, toward decisions that individually seem rational but collectively reproduce the hierarchy? Is it possible for a system this large and this interconnected to be meaningfully reformed? Or does reform at one point simply push the advantage somewhere else, somewhere less visible, somewhere the cameras aren't pointed? Because every major financial crisis in the last century has produced the same aftermath. Investigations, reports, modest reforms, and then, with time, a return to a structure not entirely unlike the one that caused the problem. Sometimes larger, sometimes more complex, occasionally with new names for the same mechanisms. The actors change. The architecture endures. Banks have classes. The financial system has tiers. You are in one of them. The question is whether you think the class you're in is fixed, and whether anyone, anywhere in this system actually has the incentive to find out.